We saw in previous chapters how after Keynes died, his theory was taken up by others who sought to connect it to the broader theories of economics. First came the neoclassical synthesis, which connected Keynes's short-run description to the classical long-run theory. Then the monetarists emphasized the importance of monetary shocks. The new classical school emphasized the importance of expectations, and the new Keynesians looked for nominal rigidities, which would hold the economy at a short-run equilibrium. Not everyone agreed with this intellectual path. The British economist Joan Robinson, who worked directly with Keynes as he developed his theories, thought that the new generation of economists were missing the point. Keynesian theory wasn't meant to describe some full employment equilibrium, which is the usual case that we occasionally deviate from. Keynes was trying to get away from the notion that such an equilibrium is the default state of the economy, but rather a rare special case with no magical properties that attract the economy to it. In the 1970s, as rational expectations was taking hold and Keynesian theory was being tossed out, Robinson pushed for a new intellectual project which would focus on what she saw as the central problem, that uncertainty about the future makes a market economy inherently unstable. This intellectual project is often called post-Keynesian, but there isn't really a unifying idea which ties it together as a school of thought like the others. But one post-Keynesian thinker, Hyman Minsky, has gotten significant attention for his model of financial markets and how uncertainty makes them inherently unstable. Minsky breaks debt down into three types of borrowers. The typical case with debt is that you have what Minsky calls a hedge borrower. This would be a person or company who has a flow of income sufficient to pay down their debts. So say a company has a decent profit margin, earning good and consistent revenues each year, and they want to expand with a new office in another location. The company projects that the new location will earn similar revenues and profits, and so they take out a $1 million loan to finance the expansion with a 3% interest rate that they intend to pay back in full over the course of 3 years. At the end of the first year, the balance on their loan is $1,030,000 after adding the 3% interest. They make their annual payment, which if they want to pay the loan off in 3 years, works out to just over $350,000. The remaining balance then accrues 3% interest over the next year, and at the end of year 2, the company makes another payment, paying that interest, but also further paying down the principal. By the end of the 3rd year, their balance is the same as their payment, and they pay off the loan entirely. Hedge borrowers have the income to pay off both the principal and the interest over the life of the loan. Again, this is the typical case. But Keynes himself pointed out a particular feature of a market economy that complicated this picture. Interest rates tend to be lower if you plan to pay back the loan quickly. This is the spread of Treasury yields in 2022, which shows this phenomenon. If you want to borrow money for 1 month, the annualized interest rate is only 0.05%, almost nothing. But if you want to borrow money and pay it back in 20 years, the annualized interest rate is 2.18%. Lenders want to lend for a short period of time because there is less uncertainty about how things will be in a month compared to how they will be in 20 years. But borrowers want to pay back loans over a long period of time. It's easy to pay back the loan if you have 20 years to do it rather than 1 month. But there is a way for borrowers to get the low short-term interest rate, but pay it back over a long period of time. Minsky calls this speculative borrowing. Our firm would take out the $1 million loan, but with a term of 1 year instead of 3, so they get the lower interest rate. At the end of that first year, the firm has to pay back the full balance of $1,005,000. You can see how the lower interest rate saves them a lot of money, but they might not have enough income to pay off this full balance after just 1 year. So instead, they only pay the interest, the $5,000. Then they go to another bank and borrow $1 million again, which they should have an easy time doing. Their assets and cash flow were enough to convince a bank to give them $1 million a year prior. So as long as things are going as planned, this new bank will be willing to do the same. The firm gets the new $1 million loan and then pays off the old one with it. Then, at the end of year 2, they're in the same situation again, owing $1,005,000. They pay the interest out of pocket themselves, but take out a new loan at the nice low yearly interest rates and roll their balance forward. And they just keep doing this, basically forever. This kind of speculative borrowing is extremely common. And to get the very best rates, many thousands of firms are rolling their debt forward every day. It's rarely in these firms' interest to pay off their entire balances because the interest rates are so low, they can get a better return by using their money to make other investments. So they only pay off the interest. If you've been going through these chapters wondering why it is that credit markets are so critical to the economy, this is why. If credit markets go even 1 day where trust fails and businesses can't get new loans to pay off these old ones, and those firms suddenly have to pay off huge balances all at once, those firms will literally be bankrupted even though their fundamentals are strong and they have enough income to make this debt structure work to their advantage. But Minsky's big contribution is in describing how that trust fails. The problem, Minsky said, were the Ponzi borrowers. If the economy experiences a long period of stability, these firms start to take on too much risk, increasing their debt burden a lot because the past few years have been good enough to justify it. They get too comfortable and think the good times will keep on coming. But then, if something unexpected happens and the firm's revenue drops, they might not have the cash flow to make those interest payments. That means their new loan needs to be bigger so that they can use it to pay the principal and the interest. And since the times have been good, banks might be willing to lower their lending criteria to allow these firms to take out bigger and bigger debts. But as soon as the assets of this firm decline in value, or they fail to rise fast enough to keep up with their growing pile of debt, they won't have the collateral to keep this Ponzi scheme going, and they'll have to default. That default will reverberate through the deeply interconnected system, and if it causes a panic, credit markets might freeze, and we'll have a full-blown financial crisis on our hands. The 2008 financial crisis played out a little differently, but this theory which Minsky put forward in the 70s and 80s describes the subprime mortgage crisis eerily well. In that crisis, the Ponzi borrowers weren't the firms, they were the people taking out those adjustable rate mortgages with big balloon payments they planned to avoid by refinancing their home, leveraging the increasing home prices to their advantage. But as soon as their asset, the home, stopped growing in value, they couldn't get a new mortgage big enough to pay off the old one, and they defaulted. And the reason they were able to do this was because the prosperity had lasted so long, everyone was willing to relax their lending criteria and take on more risk. Minsky calls this the financial instability hypothesis. He says that periods of prolonged prosperity and high optimism lead financial institutions to invest in even riskier assets. Bad news, such as a bad quarter for revenues in a major sector of the economy or a sudden rise in mortgage defaults, can set off a chain reaction of falling asset prices and a collapse in the economy. The financial markets link the economy together in a web of credit, and Minsky, in agreement with Keynes's general theory, sees the problem as human nature. People are just prone to optimism in good times, and they're myopic about the past. If the economy goes years without a bump, lending practices which were once considered prudent start to get relaxed, and the economic boom continues with the expansion of credit to riskier borrowers. Sometimes it's loans to stock traders in the 1920s, sometimes it's loans to home buyers in the early 2000s. But eventually, the asset prices used as collateral for these loans can't go up anymore, and their collapse leads to debt deflation, financial panic, and a collapse. The policy prescriptions of the financial instability hypothesis are not dissimilar to the actual policies implemented after the financial crisis in 2008. Debt relief, such as expansionary monetary policy, which pushes down interest rates and creates some inflation that makes it easier to pay off debts, or just direct debt relief like the TARP program, can help the financial system get its house in order. But add to that financial regulations which restrict Ponzi borrowing and put checks on the system so that it does not relax lending criteria and take on too much risk. In 2010, Congress passed a bill known as Dodd-Frank, which overhauled financial regulation to bring pieces of shadow banking out into the light, eliminated some regulatory loopholes for big banks, and created a system to encourage financial professionals to whistleblow on illegal practices. A fair bit of those regulations were repealed in 2018. Minsky's theories were largely ignored until the financial crisis in 2008, but their compelling narrative, which seems to describe the fundamental problems that led to that crisis, has brought them into the mainstream. This description of financial instability, when combined with debt deflation and other aspects of Keynesian theory, gives us a coherent understanding of recessions. But it isn't a complete one. The Minsky hypothesis would have us predicting recessions when the debt burden is rising over a period of stability. This chart shows total U.S. debt, both public and private, as a percentage of GDP. Note that this big spike during the Great Depression is the result of collapsing GDP, not of skyrocketing debt. But here's the other thing to note. After the Depression, the debt burden fell and remained pretty low, and indeed that period saw fewer and milder recessions. But since Minsky formed his hypothesis, the debt burden has genuinely taken off to heights never before seen. You'd think that period would be littered with recessions, but instead, it was the calmest period of stable economic growth in human history. My own take is that Minsky offers incredible and important insight into how financial crises happen and how they collapse the economy, but it doesn't quite get us to a complete theory of the business cycle.